Capitec Bank is the most successful share on the Johannesburg Stock Exchange of the post-apartheid era. Everybody in South Africa knows this brand, and everything I'm about to tell you is 100% true. Capitec was founded in 2001 by a small group of executives who left Boland Bank, a bank then in control by Cobus Visser. They wanted to build something completely different, a bank that served the people, that the big four banks ignored, a bank that was there for the domestic worker, the pensioner, the small trader, all alike. One simple card, one simple system where fees were low, products were transparent, and the queues were long because that is what they offered. This is what South Africa wanted. And it really worked because today, the bank has more than 25 million customers, more than any other bank in South Africa, despite the fact that banks like Standard Bank have been in existence for more than 160 years. 2016, it was rated the best bank in the world by the Lafferty Group. The average Capitec customer, he pays less than 50 Rand a month in bank fees, whereas if you look at all the other banks, you're going to pay about 5 times that a month. It wasn't not what had been recovered, what was expected to be recovered. And then they added that estimated future recovery in present value terms back to the gross loan book. In 2016, this added 422 million Rand. In 2017, it added 525 million. By 2018, it was 960 million. By the time the accounting standards changed in 2019, it forced the bank to recognize estimated future losses alongside these future recoveries that they're already putting into the gross loan book. And so it had to take 960 million off retained earnings, a single accounting transaction. This was always public. What I'm telling you was always hidden in the footnotes of the annual reports. It was disclosed, it was audited, PW signed off on it, and the South African Reserve Bank knew about it. The journalist who covered Capitec had access to this information, but nobody wrote about it. But there was a short-selling firm called Viceroy Research. They published a report in January 2018 saying that approximately 3 billion Rand, 3 billion, was missing from Capitec's loan book. The regulator, which is FSCA, fined this research firm 50 million Rand. You see, what they thought Capitec was doing, it was completely the wrong mechanism. The right mechanism was sitting right there in the footnotes, but they never saw it. They thought it was something else. And that's where they made the mistake. And so this book is called Boland Bankers Behaving Badly. It's not a prediction that Capitec will fail. It's an explanation about why the gap between what the bank reports and what actually happens matters. So Capitec's outgoing chief executive, he earned approximately 529 million Rand over 8 years. 305 million of that came from instruments tied to one thing, the share price. Let me explain to you why this matters. You see, Capitec executives have a remuneration factor called a share appreciation right. It's not a share in itself, it's essentially a contract. The executive is granted the right to receive at a future date the difference between the share price on the future date and the share price in which the date of this SAR, the SAR, was granted. The executive doesn't own the shares, the executive doesn't buy the shares, he doesn't pay 1 cent for it. He risks no capital at all. But if the share price has risen, by the time that the right vests, the executive receives the difference between what the share price is and when it was granted. If it's fallen, the right is obviously worth it. So Capitec's former CEO received share appreciation rights every year, and all the executives did. In a year where the share price rose 52%, that was 2025, SAR vesting alone produced 75 million Rand in compensation. This is just from 1 year. It's the kind of remuneration structure that exists at most large companies, and so it's not in itself unusual for Capitec. But what is unusual is when the same executives who are paid on the share price also control the inputs that determine the share price and the share appreciation rights. Under the accounting standards Capitec uses, every loan in the bank's book is assigned to one of 3 stages. This is common in banking. Stage 1 loans are performing. They might require small provisions depending on the rules. Stage 2 loans are deteriorating, and they obviously require much larger provisions. And the trigger to move a loan from stage 1 to stage 2 is standards that are called a significant increase in credit risk, a SICR. Accounting standards don't determine what they mean by significant. This is a definition that the bank puts out there. At the four major banks, Standards, First Rand, Absa, Nedbank, the significant increase in credit risk, the SICR threshold, is anchored at least partly to measurable things, credit bureau data, the days past due, interest rates, it's a whole lot of things. But Capitec have anchored it to an internal behavioral score on Capitec's own data that Capitec's own management review annually, and a small move in that threshold can have a meaningful change in where the loan book sits, whether it's in stage 1 or stage 2, and where our provisioning changes. And this obviously the share price responds depending on how much Capitec has written off as bad or likely bad debts in that year. The auditor tests whether the model produces outputs consistent with the criteria. So they're not really interested in what the criteria is. They don't set the standards. They are just required to test it, whether it is set as an appropriate level. And they leave that to management. An impairment charge is entirely at the discretion of management. Management pay depends on the resulting share price. And together they devised a system in which every incentive points in the same direction, the right direction, and it's at management's discretion. The argument is not that Capitec's executives has been dishonest. They probably haven't been. The argument is that they have paid themselves handsomely to exercise their judgment in one specific direction, and they've done so consistently for years. Even when the share price dropped during COVID, they still paid themselves bonuses. They found a way. It's depositors and minority shareholders that carry the consequences of their judgment. These depositors and minority shareholders, they don't have a vote on what happens. Even when they vote, it's ignored. They don't have an outside calibration in which to check, is management actually being conservative or not? All they have is the share price, which generally minority shareholders are happy with because it's been going in the right direction. If you have a savings account at Capitec Bank, your money is being used to make consumer loans in Poland, in Mexico, in Spain, in the Czech Republic, and Latvia. The default rate in those markets, by the bank's own recent disclosure, exceeds 50% of all loans issued. That means that Capitec is using depositors' money in South Africa to lend out to these countries, and more than half of that money is not coming back. You probably didn't know this. Almost no Capitec depositors do. But let me explain how this happened. In March 2024, Capitec paid 535 million rand to acquire the remaining 57% of a European online lender called Avafin. Avafin had previously been called Cream Finance. Capitec had held a 40% stake in the business for several years before the acquisition. The 535 million rand didn't go to Avafin's balance sheet. Capitec acquired the operating business. The founders kept their expertise, their networks, their proceeds. In fact, they went into competition. The terms of the exit didn't preclude them from setting other lending operations in other jurisdictions. Capitec's CEO has indicated publicly that the bank's surplus capital may be used to fund Avafin's future growth. That capital is generated by South African depositors. The depositors are raised under a South African banking license. They sit within the South African banking supervisory framework. They are insured in South Africa, but they are now funding online consumer lending in 5 foreign jurisdictions in the hopes of expanding in these jurisdictions. This is a piece of the story that has received almost no attention in South African coverage, and it deserves attention now. Before Avafin was Avafin, it was still called Cream Finance. Its Polish operation came under sustained investigation by Poland's Office of Compensation and Consumer Protection. The investigation concerned what this office called a structural workaround. When a Cream Finance borrower would not pay a short-term loan, they were pushed into a refinancing loan with another company. MDP Finance, Kim Finance, JJK, I think it was called. There's a list of them. The actual cash didn't always change hands. The compounding commission fees did. And borrowers ended up trapped in multiple layers of refinancing agreements, paying fees that it quickly exceeded the original principal. This Polish commission ruled that this cyclical refinancing structure was an illegal evasion of Poland's statutory caps on non-interest loan costs. When the Poland regulator discovered what was happening, severe financial penalties were imposed on the group. The Polish regulator concluded on public record that Cream Finance had used internal subsidiary entities specifically as a structural workaround to deliberately bypass statutory consumer protections. In January 2018, when Viceroy Research alleged that Capitec was doing something structurally similar in South Africa, namely rolling loans, using refinances to defer the recognition of arrears, charging fees for this, the South African Reserve Bank rejected the allegation. Capitec rejected the allegation. The bank's proposition was that it didn't roll loans, that its rescheduling was transparent and lawful, that it did not charge fresh initiation fees on rescheduled loans, and that it maintained strict provisioning. That defense was accepted in South Africa. The short seller was fined 50 million rand. The regulator backed the bank all the way. 6 years later, Capitec brought the company that the Polish regulator had separately found to be doing the exact same practice Capitec said it would never do. Now, banks diversify geographically. There's nothing inherently wrong with this. At 25 billion customers, Capitec's probably grown all it can. The question is whether the South African depositors understand the risk profile that they're now exposed to, and whether the bank's disclosures make that risk sufficiently clear. So a pensioner, Umtata, who has a fixed deposit with Capitec, now has indirect exposure to political and economic conditions in Latvia, a country that borders Russia, and that has been since 2002 on the front line of NATO's eastern flank. She has exposure to the Mexican peso, which has moved sharply against the dollar in recent years. She has exposure to Polish consumer credit regulation, the very regulation that fined the operation she now indirectly owns. She has not been told this to the Capitec depositor. The South African Reserve Bank has approved this. Capitec's capital adequacy ratio of 33% provides a substantial buffer. But the reality is the AVAFin loan book is growing at around 48% for year. At that growth rate, the South African book growing at a more modest 10% annually, AVAFin will eventually represent 1/5 of Capitec's total loan book in about 5 years. That pensioner Mtata is the party that's taking the risk, but she's not the party that's earning the premium. My book is called Boerland Bankers Behaving Badly. It's not a prediction that Capitec will fail. It's an explanation of the gap between what the bank reports and what's actually happening. And that matters. Why? Because when banks fail, they always fail for the same 3 reasons. 350 years ago, in 1672, Charles II of England stopped paying his debts. The bankers he had borrowed from lost everything. The depositors lost everything. The reasons that banks fail have not changed since then. Bankers have just got better at hiding things. Sign up on my email list and I'll give you a copy of this ebook for free. If you'd like to buy the hard copy, I'm only printing 1,000 of the current revised version of this book. Only 1,000 hard copies will be printed. I'll sign them. They will all be numbered.